Hey everybody, it's Adam Haney with Emory Financial, and today, June 15th, as expected, the Federal Reserve hiked rates. And the only surprise, a little bit of a surprise, not really, was that they hiked rates by 0.75% as opposed to what was previously telegraphed of 0.5%. So why did they do this? Well, the Fed is trying to deal with getting this inflation under control. And as this headline from Reuters states here, that is the largest rate hike since 1994. Usually when the Fed rate hikes rates, it's in 0.25% to 0.5% increments. But because the inflation is so hot, as we can all feel it in gas prices, grocery prices, etc., they realize that they really have to step in and do something about this in order to curb inflation. Now, what does that mean to you and what can you do about it? So what I want to do is show you a chart of mortgage-backed securities here real quickly because it's a little bit counterintuitive. And we discuss this often, but when people see that the Federal Reserve hike rates by 0.5% or 0.25%, whatever the case, in this case, 0.75%, oftentimes buyers assume that must mean mortgage rates went up by that same amount. But that's actually not the way it works, because when the Fed hikes rates, what they're doing is they're hiking the short-term rate that banks lend each other overnight. And the types of loans that have a direct impact, that are directly affected by these Fed rate hikes, are short-term loans such as home equity lines of credit, car loans, credit cards, etc. So if you have an equity line, you're going to see that the rate on your equity line is 0.75% higher next month. And on credit cards, those are also going up. So those have a direct one-to-one relationship. Okay, the long-term loans, such as mortgage loans, are indirectly impacted by the Fed rate hikes. And as we see today, it's not what you'd expect. So what I'm showing you here is this chart of the mortgage-backed securities on the 4.5% coupon. And surprisingly here, this up green 122 basis points up means that the mortgage bond actually had a good day today, despite the Fed hiking the rates by 0.75%. So if I scroll down here and show you this chart, this goes back to the last quarter, so going back to about March 15th or so. And what it does is it just shows this gradual downward trend of the price of mortgage bonds. And as the price of these bonds goes down, it means that the interest rates have been going up. And as we can see, as we know all too well, the rates have been definitely trending up over this year, and very precipitously just in the last month or so. So we have signs of a big sell-off in the bond market marked by these red candle patterns that go in a downward direction. And again, when the price of the bond goes down, the interest rates go up. So how is it that today, when the Federal Reserve actually hiked rates by 0.75%, the Fed funds rate, that we have the bond prices go up and mortgage rates come down? Well, we kind of have to read the tea leaves a little bit here, and what the Fed is basically signaling to the market. And originally, the Fed was anticipated to hike the rates by 0.5%. But because the inflation numbers have come in so hot recently, like 8.6% on the consumer price index recently, the Fed decided they needed to get serious. Of course, they're always serious, but they need to get a little bit more aggressive with this inflation. And so what they did is they hiked the rates by 0.75%. Now, it was somewhat expected, but in the end, the mortgage market liked it, because what the Federal Reserve did is they signaled that they're going to get aggressive. They're going to get serious about curbing inflation. And so when they did that, it gives bond traders, mortgage bond traders, comfort, confidence, etc., that the value of their bonds, these 30-year fixed bonds, mortgages, are still going to have intrinsic value 5, 10, 15 years down the road, and that the fixed rate of return on these fixed investments won't be eroded away by inflation. So when the Federal Reserve got aggressive today with its 0.75 point rate hike, we actually had a pretty substantial bond market rally, and we finished up 122 basis points on the day, which is actually a really phenomenal day in the bond market. Now, granted, interest rates are still the highest we've seen in 5 years. So we're looking at rates that are, in the high fives, close to 6%, depending on the product and characteristics, etc. So here's what you need to do about this. If you have an equity line or credit cards that were impacted by this Fed rate hike today of 0.75%, you should do whatever you can to get those paid off or paid down, because those short-term rates are going to continue to go up. On the other hand, if you have a longer-term loan, like 30-year fixed-rate mortgage, or I should say you're a buyer, okay, despite the interest rates having moved up like they have, and despite home prices moving up like they have, there's still a very strong demand appetite for homes. Not as much as earlier in the year or last year when rates were 2.5% lower, but there's still a demand out there, and the demand is driven by a supply shortage. A simple economics 101, supply and demand. And so if you're a buyer looking to get into the market, contact me, because there are some unique things that we can do, some strategies that we can employ to help buy down the interest rate for you, called the seller buy down, and we'll get into that. So reach out to me with any questions on that. But I just wanted to give you this update here, hopefully sort of explain some of the confusion between Fed rate hikes versus mortgage rates going up or down, and how is it that mortgage rates can go down when the Fed hikes rates up. So a little bit of topsy-turvy world, but always happy to answer your questions and go over your particular scenario. So feel free to reach out to me, and I look forward to talking to you. Have a great day.